We're here today to launch our July bi-monthly report. The Irish commercial property market has had a very busy first half to 2019, with several large occupier and investment transactions having completed and other transactions underway or in legals across various sectors of the market. For the most part, transactional activity in many sectors of the market is expected to be down quarter on quarter in Q2, with several transactions that would, for whatever reason, didn't complete by June 30th, meaning they've now fallen into Q3. The second half of the year is therefore likely to account for the lion's share of transactional activity in many sectors of the market in 2019. Although Brexit uncertainty will now carry over into the autumn months, the Irish economic backdrop remains solid, buoyed by strong job creation, which in turn bodes well for the commercial property sector and market. Recent guidance on interest rate movements also bodes well, considering the very substantial differential between 10-year bonds and real estate yields, which, combined with economic, demographic and occupational factors, makes for a very compelling investment case for Irish real estate. With a strong 3.7% year-on-year increase in job creation achieved in the Irish economy in the first quarter of the year, much of which comprised office-based employment, activity in Dublin's office occupier market remains robust at the mid-year point. That said, Q2 take-up in the capital is expected to be somewhat lower than the volume achieved in the first 3 months of the year, by virtue of the fact that a number of transactions hadn't closed by the 30th of June and will now carry over into Q3. Although there have been few new requirements announced recently, overall demand at over 370,000 square metres remains elevated, with a significant number of requirements to be fulfilled, including a large KPMG requirement where considerations are ongoing at present. Interestingly, there's been evidence of increased appetite for offices in regional cities over recent months. An increase in lettings to flexible office providers continues to be evident in the market, with several deals in progress at present, and indeed some new entrants such as the US flexible provider Notel, now actively looking for opportunities in the Dublin market also. From a design perspective, occupiers continue to focus on the provision of working environments that foster collaboration, support new ways of working, and indeed help to attract and retain top talent, as evidenced by the rollout of CBRE's recent Workplace 360 fit-out. Prime office rents in Dublin remain stable at the mid-year point. In the industrial sector, demand for modern industrial buildings in strategic locations around the M50 and indeed the arterial routes continues unabated, led for the most part by requirements from the logistics, e-commerce, data centre and food and beverage sectors. There's also been an increase in demand from indigenous occupiers for units extending to less than 1,000 square metres in recent months. The strong volume of inquiries and inspections underway in the Dublin industrial and logistics sector is not necessarily evident from Q2 transactional evidence, with few large transactions signed in the last quarter and a considerable volume of stock reserved or in legals and expected to sign in the second half of this year. A significant proportion of acquisition activity of both buildings and land continues to occur off-market. We continue to see some new speculative developments commencing, which is encouraging considering the scarcity of modern industrial buildings in highly sought-after locations. While prime industrial and logistics rents remain stable at the mid-year point, there has been an increase in rental levels for secondary buildings in the last couple of months, and this is expected to continue to put upward pressure on both prime and secondary rents in the industrial sector during the second half of 2019. On the back of continued strong job creation, wage inflation and Ireland's unique demographic profile, consumer spending in Ireland continues to perform well in comparison to other jurisdictions and in particular the UK. Visa's latest Irish Consumer Spending Index signalled a modest increase in spending in Ireland in May, with a 3% decline in face-to-face spending being counterbalanced by an increase in e-commerce sales in the Irish market in the period. Demand for retail premises remains robust, although less reliant on the fashion sector, with strong growth in the health and well-being, beauty and leisure sectors of late. Indeed, the distinction between retail and leisure continues to blur. Despite the scarcity of retail stores to satisfy demand in key locations, retailers continue to expect flexible lease terms, and retailers are exercising patience to secure the specific units that best meet their needs. There are a number of transactions currently in legals which will see some interesting retail announcements being made in the second half of 2019. Construction is progressing well on a number of new retail schemes in the Dublin market. In addition to the planned new town centre scheme at Cherrywood in the south suburbs of the city and some other schemes in Dublin city centre, works have now started on the Pembroke district in Dundrum, while at Liffey Valley Shopping Centre in the west suburbs, work is currently underway on the delivery of a new TK Maxx store. There has been an encouraging volume of activity recorded in the Irish investment market over recent months, both on and off market, with strong demand continuing to prevail for prime assets. Transactional activity, like in other sectors of the occupier market, will be heavily skewed towards H2 in 2019, with the completion of several ongoing investment transactions having now carried over into the second half of the year. Some assets in the Irish investment market are now being acquired by Asian investors, and these transactions typically take longer to syndicate, fund, and ultimately complete. Prime yields in the Irish market remain stable at the mid-year point, and in some cases have potential to harden further, particularly when recent government bond rate movements and indeed guidance on interest rate trajectories are taken into consideration. The one exception is the retail sector, where some yield softening has already been experienced, in line with the trend being experienced across all of Europe at the moment. Interestingly, the softening in retail yields has unearthed several new opportunistic bidders who are specifically seeking higher yielding retail investment opportunities, particularly those that offer stable long-term income streams. Activity in the build-to-rent sector in Ireland has increased further over the last couple of months, with considerable off-market activity in this sector at present. With very little existing build-to-rent product available to purchase, most transactions, both single asset and portfolio sales, are forward commit structures, although we will see some forward funding becoming a feature of the market during the second half of 2019. Developers intending to create institutionally acceptable build-to-rent product need to invest in detailed research at the earliest possible stage of the process to ensure that schemes are not only viable but also specifically tailored to the local demographic and contain the correct mix of amenities for that catchment area and that target market. In addition, the construction pack needs to be of the highest quality, with appropriate warranties in place from the outset for both contractors and design teams, in order to attract institutional capital and ultimately achieve superior pricing. Rent pressure designations were recently extended to the 31st of December 2021, providing certainty to investors on residential rental growth prospects for the foreseeable future. Meanwhile, new reforms to regulate short-term tourism-type lettings in rent pressure zones came into effect on the 1st of July. Prime build-to-rent yields remain stable at 3.85% at mid-year 2019, but are expected to harden further over the second half of this year. There has been increasing evidence of price stabilisation in the development land sector over recent months, as developers react to easing house price inflation, affordability and rising build cost inflation. While we continue to see transactional activity being recorded and particularly strong demand for sites guiding up to €5 million, most of the land that's coming to the market and transacting at present comprises relatively small infill sites, meaning the overall spend on development land in Ireland is likely to be down in 2019 on a year-on-year basis. In addition to developing out existing schemes, much of the focus on this sector at present is on design, consultancy and planning, as developers prepare to lodge the next wave of planning applications and focus on potential rezoning opportunities in forthcoming development plans. As in other sectors of the market, much of the activity in the development land sector at present is occurring off-market. We expect to see an increase in the volume of land sales by religious orders in the second half of 2019. We are now in the midst of the busiest tourism season of the year, following an increase of more than 6% to 2.027 million of overseas visitors to Ireland in Q1 2019. This bodes well for the hotel sector of the property market, where demand remains high and is likely to increase further as a result of new reforms to regulate short-term tourism-type lettings in rent pressure zones, which came into effect on July 1st. A rise in the number of hotel rooms coming on stream has had a stabilising impact on various performance measures such as average room rate and revenue per available room in the last couple of months, which is welcome from a competitiveness point of view. From a transactional viewpoint, however, demand continues to outstrip supply, particularly for hotels in Dublin city centre. However, hotel sales in the first half of 2019 are clearly not representative of the underlying volume of activity, with several large transactions at various stages of negotiations at present and legal processes, and now not due to complete until the second half of the year. There has been quite a bit of activity in the Dublin pub market in the last couple of months, following a relatively sluggish first quarter in which only 4 Dublin pubs formally changed hands. There's been considerable activity both on and off market in the sector of late, with several pubs having gone sale agreed or signed in the last couple of months. This is fueled by very strong trading conditions and the improved availability of funding in this sector. From an occupier perspective, there's been a discernible increase in inquiries for both office and industrial properties in Cork over recent months. The region's relative attractiveness compared to other competing cities such as Dublin is becoming increasingly evident. Indeed, take-up in the Cork office market in the first half of 2019 was particularly encouraging, with notable lettings to Clearstream, KPMG, Forcepoint and the biopharma company Stryker, all recorded in the last 6 months. From an investment perspective, although supply remains constrained, investor appetite for well-located Cork properties remains healthy, as evidenced by the strength of appetite for the Half Moon Street mixed-use office and retail development in the city, which has recently gone under offer. The Park Avenue residential portfolio of 62 apartments off the South Douglas Road in Cork, which is guiding €17.5 million, is currently being marketed and expected to generate considerable investor interest. All in all, it has been a very busy first half to the year in many sectors of the Irish commercial property market, but the second half could actually be busier again. The months of July and August will clearly be focused on completing all of the transactions that are currently in negotiations or legals before the traditional autumn season kicks off in earnest in September. To download our full bi-monthly report, please visit the newsroom of our CBRE Ireland website at news.cbre.ie.